As of 10:07 a.m. Eastern Time on November 6, 2025, shares of Uber Technologies, trading under the ticker UBER, are sitting at $92.34. That's a drop of about 41 cents, or 0.44%, in the opening hour of trading. The stock is showing some early volatility, having opened at $92 and fluctuated between a low of $90.82 and a high of $92.50. This movement comes on the heels of the company's recent third-quarter earnings report, which has created a fascinating split in the market's reaction. The immediate hook here, the thing that is likely confusing many retail investors, is that Uber just posted strong results. Gross bookings surged 21% year over year, which is a significant acceleration. Yet, the stock is under pressure, having seen a sharp 9% drop in the immediate aftermath of that very report. This is the perfect example of the expectation versus the reality. The expectation was that Uber, the newly minted profitability story, would simply post a beat, and the stock would continue its upward climb toward its 52-week high of over $101. The reality is that the market has moved past the simple question of, can Uber make a profit? And is now intensely focused on a much harder question. Can Uber expand its margins fast enough to justify its massive valuation? The post-earnings dip was a direct result of concerns about margin expansion, particularly in the highly competitive delivery segment. For years, the common narrative surrounding Uber was its relentless cash burn. It was the poster child for growth at all costs. Now, that story has completely flipped. The general belief, fueled by several quarters of positive net income and strong free cash flow, is that Uber has successfully transitioned from a disruptive startup into a mature, profitable tech platform. Wall Street analysts are overwhelmingly positive, with a strong consensus buy rating on the stock. You'll hear talk of its dominant platform, the network effects of its two-sided marketplace, and its expansion into new verticals like grocery and freight. But this optimistic view is now being challenged. The reality is that this newfound profitability is fragile, and, more importantly, it's being judged on a much harsher scale. The market is no longer giving Uber credit just for growing. It's demanding efficiencies. This recent volatility isn't happening in a vacuum. Today's intraday chop follows a rough patch. The stock is down over 3.5% in the last 5 trading days and has shed over 4% in the last month. This decline is almost entirely a response to the earnings data and the subsequent recalibration by major financial firms. We saw a flurry of analyst actions that perfectly capture this tension. On one hand, firms like D.A. Davidson and Bernstein raised their price targets, impressed with the raw top-line growth. But on the other, BMO Capital and UBS slightly lowered their targets. They see the same growth, but are worried about the cost. They're looking at the delivery business and seeing a segment that, while growing, is facing intense competition and is not contributing to margin growth as robustly as investors had hoped. This is the new battleground for Uber. The market is worried that to keep growing, Uber has to spend more, which eats into the very profits investors are now counting on. It's also worth paying attention to the undercurrent of institutional positioning, which brings us to the short seller perspective. When you look at Uber, it's not a classic heavily shorted meme stock. The short interest as a percentage of the float is relatively low, hovering around 2.5 to 2.6%. This isn't a sign of a massive coordinated attack betting on the company's demise. Instead, it represents a large, sophisticated, and structural hedge. With about 52 million shares held short, these are typically large funds that believe the company is simply overvalued. Their thesis isn't that Uber is going bankrupt. Their thesis is that its valuation has gotten ahead of its actual earnings power. This brings up a fascinating debate currently happening on forums like Reddit. If you look at Uber's trailing 12-month PE ratio, you might see a number as low as 11 or 12, which looks incredibly cheap for a tech growth company. This has many retail investors arguing that Uber is a crazy value. But the short seller and institutional bear thesis rests on the fact that this PE ratio is misleading. It was heavily influenced by a massive one-time tax benefit. If you strip out those non-operational gains and look at the company's actual operating income, as some analysts have pointed out, the operating multiple is closer to 47 times. This is a much more expensive and perhaps more accurate valuation. What's your take on the PE ratio debate? Is Uber genuinely cheap at a 12 PE, or is that figure just noise from one-time benefits? For investors trying to navigate this, the key is to understand what to watch. The short float of 2.5% isn't high enough to signal an imminent squeeze. The days-to-cover ratio, which measures how long it would take all short sellers to buy back their shares, is sitting around 3 to 4 days. That's moderate. It means there's a respectable amount of bearish sentiment, but it's not an explosive powder keg. Actionable steps for investors don't involve looking for a squeeze here. Instead, it's about monitoring the cost to borrow shares. You can find this data on platforms like Thintel or through some advanced brokerage accounts. If that borrow rate starts to spike, it means the demand to short the stock is increasing, which could signal that more large institutions are adopting the overvaluation thesis. The other key metric to watch is institutional filings. We know firms are adjusting their positions post-earnings, and seeing who is trimming or adding will be very telling. So what does Uber actually do to command this near $200 billion market capitalization? It operates two main business segments. The first is mobility, the ride-hailing service we all know. This is the mature, profitable engine of the company. It's the cash cow. The second segment is delivery, which includes Uber Eats and its newer fast-growing grocery and retail delivery operations. And then there's Uber Freight, a logistics platform that connects shippers with carriers, which is a massive but challenging industry. The company's current strategy, and the source of all the market tension, is to take the high-margin profits from the mobility segment and reinvest them heavily into growing the lower-margin delivery segment, especially in competitive areas like groceries. Management is also channeling those profits into their long-term bets on autonomous vehicles, which CEO Dara Khosrowshahi has referred to as a hybrid future of both human drivers and robotaxis. This is where the entire bull and bear case collides. Bulls see a company with a dominant, profitable core business that is funding its next two waves of growth, on-demand delivery of everything and an autonomous future. They see a path to it becoming a trillion-dollar company by owning the entire A to B logistics space. On platforms like X, formerly Twitter, you'll see bulls arguing that autonomous vehicles are a massive opportunity, allowing Uber to eventually remove the driver from the cost equation and capture much higher margins by owning its own fleet. Comment below what you think Uber's biggest long-term risk is, regulation or autonomous competition. Looking ahead, the path for Uber is complex. The expectation was that achieving profitability was the finish line. The reality is that it was only the starting line for a new, more difficult race. The company now has to prove it can execute a difficult balancing act. It must keep growing its core mobility business, fend off intense competition in the low-margin delivery space, and invest billions in an uncertain autonomous future, all while simultaneously expanding its overall profit margins to satisfy a very demanding market. The next few quarters will be critical. Investors will be watching to see if the margin compression in delivery was a one-time blip or the start of a trend. They'll be listening for any updates on the regulatory front and for any new partnerships in the autonomous space. In the end, the story of Uber is no longer about disruption. It's about execution. The market's expectation has shifted from "can you grow" to "can you grow profitably and efficiently at a scale that justifies this price?" The recent earnings reaction showed that the company's reality, strong growth but with margin concerns, fell short of that new, higher expectation. The stock is now in a show-me state, where positive press releases are being ignored in favor of hard data on margins and free cash flow conversion.